Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Credit Strategies in the Quest for Yield, is a continuation of the session that we first held in April of 2009, when we suspected that a big opportunity set was erupting after the great credit crisis of 2008. Today's session is a look into some credit strategies that are mining some very nice profits. Our speakers are the best in their class. I'll briefly introduce them after I say this. Our speakers' views are their own and don't necessarily represent the views of the Roundtable, its trustees, or the board. Jeff Birch launched Venner Capital Management in 2005. Venner is an opportunistic credit hedge fund that focuses on leveraged corporate credit structures. Before Venner, Mr. Birch served as head of distressed prop investing and the trading business at DLJ/Credit Suisse. Sitting next to Jeff, Phil Winewood is the founder of Sear Capital, a credit-focused hedge fund in New York. Before Sear, Phil ran the fixed income and derivatives market for Deutsche Bank in the US and Canada. Before that, Mr. Winewood was head of Deutsche Bank's securitized products businesses. Phil also served on that firm's Capital Markets Executive Committee. And sitting next to Phil, Bao Truong is a portfolio manager at Centerbridge, a credit-focused hedge fund. Bao's investments are focused in the energy and power sector. Before Centerbridge, Mr. Truong was a partner in the credit business at Fortress Investment Group, where he concentrated on investments across the corporate capital structure with a focus on distressed and special situations. Before Fortress, Bao was a member of the distressed research and trading team at Lehman Brothers. And the moderator of the Greenwich Roundtable today is Ted Seides. Ted is the president of Protégé Partners and the chairman of our programming committee. Please welcome Ted as he sets up the table for us today.
Thanks, Steve. Credit, as we all know, and at times forget, is a cyclical business. But thanks to our friendly helicopter-dropping Ben Bernanke, we have low treasury yields for the millennium. That's this millennium, the entire thing, probably. That has led investors to a massive thirst for yield that we have not seen since 2007. So here we are sitting trying to make analogies. As we know, history does not repeat itself, but it often rhymes. So does it rhyme with 2006? Are we sitting here a few years before we hit the wall? Or maybe it's more like early 2008, where we all feel very good, but are about to hit on hard times. Maybe it's late 2009. You know, the going's getting good and it's just going to continue for a long time. Or maybe it's Japan in 1993, and we're going to see ups and downs going nowhere for the next 20 years. Today we have three terrific and different perspectives to help us figure out where we are, and perhaps more importantly, to ignore where we are and help us find some great opportunities today. So, Jeff, why don't you get us started?
Sure. Good morning. Thank you for having me. Venner is a credit opportunity fund. We invest in leveraged corporate capital structures, including equities, and we do that with a value and event-oriented approach. Our driving philosophy is to identify situations with outstanding risk-reward characteristics in order to generate capital appreciation. We don't really focus on carry. We are not a typical high-yield investor. We are a special situations investor. We strive to source, analyze, and value asymmetric situations that typically fall into the distressed or stressed category, and almost in every situation have some level of process associated with the outcome. There are two requirements for every investment we put into our portfolio. The first is that we try to buy our investments, buy the securities at a discount to what we view as intrinsic value, or in other words, we want a certain level of a margin of safety. And we also want, because we do focus from an event-driven perspective, we focus on catalysts. And those catalysts typically occur within 6 to 18 months. Mike Ortel, my partner, and I each have 20 years of investing experience within the distress space. We launched the fund in 2005 after running two of the most successful distressed proprietary desks on Wall Street. I built DLJ's distressed proprietary business, which ultimately became Credit Suisse. And Michael, he was the head of research for their global distressed business for their proprietary side. The partners in our families are the largest aggregated investor in the fund. We have approximately $1 billion of assets under management. We strongly believe in being very thoughtful about risk management, which we, I think more so than ever, believe is incredibly integral to our success. I think that we really strive to focus on gross positioning within a capital structure, and keeping that portfolio incredibly nimble as we like to move around our gross positioning depending upon our views on the overall markets. In addition, clearly a subject that I think a lot of people have been focusing on, hedging relative to this type of area. We focus on it, but we try to keep that to a minimum, and I'll talk about that in a little bit. I have two questions, basically, I'd like to ask. The first one is, do we all here, and I'd love to see a show of hands, do you believe that we're near the top of the credit cycle? Top of the credit cycle? Some, kind of? Okay. We think that we're near the top of the credit cycle right now. But even with that, we believe that there are some, the current market offers some really interesting pockets of opportunity that have great risk-reward prospects. And we think that both in the credit market, where I think a lot of people are tending to shy away right now, as well as within the equity markets. I mean, it's kind of challenging to sit in front of you and say the high-yield market's cheap when the index is trading sub 6%. The market has never traded sub 6%. So we could come back to that and talk about that in a little bit, but it's hard to say high yield's a great, interesting prospect at this moment. We are not a high yield or a loan fund. We really just run a concentrated book of special situation investments. So we clearly need to be cognizant of what's going on in the credit markets, the high yield market, investment grade market, but it's not, as I said before, it's capital appreciation. So we look at ourselves more like a long short equity manager, but that where we express the majority of our views through credit investments. The second question that I'd like to ask is, do you believe that currently there are opportunities to make money in event-driven and more specifically distressed investing? Distressed investing, something? Good. Because we strongly believe that it's actually a really interesting time to invest in distressed right now. In addition to some classic value situations, we are very excited about opportunities in middle markets, in Europe, merchant power, and liquidations. And I'm going to spend the next 10 minutes or so talking about those opportunities. There's no question, and Ted even kind of spoke to it before, that the majority of these opportunities emanate from the massive U.S. and European government intervention. Treasury yields down to historical lows has clearly forced investors to look for riskier assets for yield. As a result, we've seen kind of a bifurcation in the credit markets. We've seen the liquid and semi-liquid securities act completely differently. I mean, they've all risen, don't get me wrong, but there's clearly been a huge difference between the two. Last night, there was an article on Bloomberg talking about in the current high-yield environment, there is anywhere between, it's the largest spread they've ever seen for new issue product that is sizable, 500 million and larger and 500 million and smaller, to the tune of 100 to 200 basis points for similar credit statistics. So from our perspective, if you can take that to a wider margin and look at more distressed and stressed opportunities, what we're seeing, and I'm going to talk about this in a moment, we're seeing this huge difference between defaults between the overall market and what we view as middle markets. So that middle market strategy, which falls into kind of that semi-liquid category, has been and continues to be a main focus for our fund. Since inception, middle markets has accounted for 50% of our attribution, our return attribution. I will define middle markets as those companies that have a capital structure between $250 and $2.5 billion. We think that most of these, or a large portion of these investments, are underfollowed, undervalued, and in many cases just misunderstood. So in the last 12 months, just to give you just data, in the last 12 months, U.S. defaults for credits, for issue sizes smaller than $500 million, actually I apologize, smaller than $400 million, has been 3 times higher than that of the overall market. So the overall default market's been ranging anywhere between 1.3 to 1.5% on an annualized basis over the last 12 and then I would say 24 months. Last year, the middle market space had defaults close to 5%. That's a pretty significant difference. It's an area that we clearly think will continue, because if anything, we believe that regulation, banking regulation, the banks that are making loans to these types of companies is getting more challenging, not getting easier. Even with all that liquidity, you're still seeing a default rate of close to 5%. That is going to continue, we believe. So from our perspective, investing in this area is quite interesting because, number one, it allows us to get incredibly granular. How much easier is it calling a CEO of a company at a $1 or $2 billion company, having a first-name relationship basis, whether you could talk to them once a week, once a month, versus calling a $50 billion company? It's quite different. And so for us, that granularity offers us the ability to get very deep into our work, and we run a fairly concentrated book. Our book typically has about 20 positions that would account for about 90% of the risk. So we like that opportunity to have direct dialogue with the management team. We think it's quite important. Second, there's certain limitations in investing in these types of capital structures because some of our larger peers just doesn't move the needle for them. So there's just less competition. And then thirdly, it offers a significant amount of diversification for our investor base. I would say about 30-40% of our book, on average since inception, at a minimum, has been in names that we don't have a lot of overlap with other hedge fund peers. Some current examples that we're invested in are Homer City, Rotec, Stallion Oil, names that you just don't hear in a lot of other portfolios. Very briefly, just to talk about one of them, Stallion Oil is an energy field services business. Basically, when a fracking business sets up, they will come in, they will set up the tents, they will do all the liquids, they will do everything that business needs other than the actual drilling. It's a variable cost for these drillers. Stallion Oil is 10 times larger than its nearest competitor. It's been built up over the last 5 to 7 years. It came out of bankruptcy. It trades approximately at about 3.5 times EBITDA, while all of its peers that are larger, that have like small components of it, trade close to 5 times EBITDA. So we're buying it at a discount versus its peer group. But it has, over the last year, with natural gas prices coming in, because they've been growing so quickly, the business has been flourishing. EBITDA's up, the margins are up. The company basically came out into the market about 2 months ago and said that they were going to do a dividend deal to pay back 50% of their equity. And then last minute they pulled the deal because we believe there are a number of buyers, a number of acquirers of this company lurking, and they decided instead of doing a dividend deal, they just might as well put the company up for sale. Was one of our top returning investments at the end of last year. The next area that I would like to focus on is Europe. Clearly, Europe has received a lot of attention in the credit space. I think, unlike many of our peers, our view within the credit space is a little different. We do not believe you're going to see selling en masse by the banks in Europe. We think that due to the liquidity being provided to these banks, as well as the fact that many of the countries do not have, many of the banks that have not gone through restructurings, they don't have the ability to take losses at the moment. And so we're seeing very little come out in the way of loans from the large loans from the banks. And if anything, what we're seeing is a lot of hedge funds who have set up infrastructure there, built out teams and launched funds for that space, really competing in an aggressive way for very few opportunities. And we don't like the risk-reward aspect there. What we do think is interesting, again, is middle markets in Europe. So, during the last 12 months, European defaults were over 5%. They're expected to be, and this ranges, depending upon the investment bank you speak to, anywhere from a low of 2 to a high of 6. But let's extrapolate on this bifurcation we're seeing here in the U.S., where middle markets are 3 times as large. The banking community is more challenged in Europe than it is here in the U.S. So if you use 4 or 5% as your starting point, could you potentially see close to a 10% default rate for middle market credit? We think you can. And we think that over the next 2 to 3 years, there's going to be a lot of very interesting opportunity in Europe in that middle market space. The banks are already starting to sell some of their smaller deals. We have already started purchasing some middle market type of opportunities over the last 12 months, and we think it's only going to get better. In addition, not all troubled companies end up filing for bankruptcy. They don't go through default. A lot of them, a larger component, actually just say stressed. We think that stressed opportunity could be multiples of what we see in default. So if you think middle market defaults could be, call it 5 to 10% in that range, you could see stressed opportunities getting close to 20%, 30% for middle markets. Some current examples in our portfolio are Perstorp and Cattles. Perstorp, for example, Swedish specialty chemical manufacturer. We bought it 5 times EBITDA through a third lien mezz tranche. A lot of these deals are done first, second, and mezz tranche in Europe, the LBO deals. All of their competitors trade for an excess of 6.5 times. You look at M&A for the last 12 months, it's been in excess of 7.5 times. And there was a catalyst in that their whole capital structure needed to be refinanced by the end of last year. And so in December, they refinanced this capital structure, and debt that we were buying 9 months earlier between 75 and 80 with the LIBOR plus 1250 coupon was taken out of par. So great opportunity in terms of Europe, middle markets. We think that's going to continue. Merchant power generation has been and continues to be one of our favorite areas. We believe that there is a very interesting opportunity today as a result of the compounding effect of depressed natural gas prices, as well as the inability or unwillingness of companies to comply with the upcoming EPA regulations. So basically, about a decade ago, the government put in place a new group of regulations that are going to challenge many of the coal power-producing assets here in the U.S. Those go into effect in 2015. So aside from buying into a lot of these capital structures when they're having trouble due to low natural gas prices, what we're sensing right now is that you are potentially going to be able to buy into these, call it low valuation types of opportunities, where in 2 years from now, you could see in particular regions in the U.S. anywhere between 10 and 30% of supply come offline. Because a lot of these companies, these older companies with coal plants, A, they can't afford what it would cost to scrub their facility to become compliant with these new stricter guidelines, or B, they're just unwilling to go down this path. And so we think over the next 2 to 3 years, you're going to see a huge increase in valuations in certain areas for power producers. We have published a white paper on the opportunity. We brought copies of that if you'd like it, and it really expands on our view. Some current examples in our portfolio are Longview Power, Dynegy, and Homer City. Lastly, I just want to talk about probably the area that we think today offers, we think, probably the most compelling risk-reward opportunity within the credit markets, and that's liquidations. Liquidations, very simply, are investments that are in companies that will cease to exist. It is just basically selling off the assets and paying back the creditors. 35% approximately of our portfolio are in liquidations right now. They accounted for over 50% of our return last year. They are incredibly low beta types of situations because you're basically just buying cash at a discount, and so you're waiting for what that future value will be, and then basically you're trying to come up with what type of timing there'll be in getting you paid your money back. Some current examples in our portfolio are one that everybody I'm sure has heard of in this office, in this room: Lehman Brothers, Madoff, Glitner, ResCap, and then Cattles, which I mentioned earlier. The greatest thing about these investments is that while on a blended basis we believe you can generate gross returns somewhere in the mid-teens, and hopefully in certain cases exceed 20% if you get some upside out of these positions, is that the downside is just incredibly limited. And the beta of these positions, if you look back over the last year or two, has been just almost non-existent. So very simple, we could speak maybe Cattles for a moment. Cattles is a UK specialty lender. We've been in the investment for almost 2.5 years now. The company, through the global crisis, went through bankruptcy. It's been in a scheme of liquidation since. This business has been paying over the last 2 years monthly dividends, monthly not dividends, but monthly payouts. Our return has exceeded 20% since inception on this investment. We believe going forward, there have been a number of new investors who've come into the name, which have pushed up prices. So we believe our base case now is more like 12 to 14%. But there are a number of upside opportunities with this credit, such as the litigation that's going on, as well as the platform. So forget about selling off their assets. There's now a chance that some of the platforms they have actually will be purchased by competitors, which could add to value significantly. And we think you could get in excess of 20% on that investment as well. In addition, not only do you have direct investments in a lot of these particular credits, but you also have kind of offshoots where there's opportunities outside of the actual direct claims. So Madoff, for example, has many feeder fund types of opportunities. We're invested in about 3 or 4 of those. And when we look at our portfolio for this year, we believe that some of these feeder fund opportunities actually have the most upside, the best asymmetry in our portfolio. In certain circumstances, we think we can generate over 100% return on some of these investments. So that's kind of our view on the space. We think there's a lot of opportunity. I haven't even kind of spoken about equities, which we believe at this moment, at least for the next 3 to 6 months, offer some really interesting upside opportunity as a whole. But within our opportunity space right now, we are very excited, and we think that 2013 is going to be a very good year. Thank you.
Jeff, thanks for laying out some interesting opportunities. I want to ask you a question about risks. So, you touched on even the middle market. You got 5% default rate. It could go up to 10%. Anytime that happens, there's usually pain before the good opportunities come. High yields are below 6%. Cost of stock borrow in small cap stocks is 2%. Now, are you looking at short opportunities, and can you use the credit? How do you use the credit analysis to try to? Are there opportunities to identify which 5% are going to default next? How do you think about that?
Sure. So, the challenging part investing in leveraged corporate capital structures is that typically the credits that are most interesting to short are the credits that liquidity can provide. Can be the white knight for. So you take the last year, if you shorted some of the triple Cs that you thought were really interesting short prospects that had a real high likelihood of default, and you were wrong, well, those were the highest performing, the best performing investments in the market last year. Beta really just takes over, provided because of that liquidity, because of that yield grab. So the challenge is, I think, not utilizing the credit analysis skills that we bring to the table to find the names. It's timing these names appropriately. Because putting on a credit bet when, let's say, it's trading at 60, 70 cents on the dollar and has a 10% coupon, and maybe it's way over levered compared to their peer group, but happens to be in one of these large LBO capital structures where let's say you have a number of different private equity sponsors, sophisticated equity sponsors, and you're trading at 8 times EBITDA, all that at the bottom part of the capital structure, but their peers are trading at 5. You say, well, wow, that's over levered, and they're probably going to run out of money, and there's a maturity issue, and all of a sudden the company turns around because of the sophistication of the financial sponsors, and they do an amend and extend. And then those investments that are at the bottom of the capital structure, they trade up 20% because there's so many people short. So it's a real challenge to use your analytical ability and then couple it with your trading ability. And I think right now, our view is while you're at 6%, probably the only, on the overall high yield market, the only area that we feel comfortable shorting are those areas where you're not paying a very large coupon on a monthly basis for the short. So where we've been focusing our time is more on the crossover high grade space, where I think it's much more likely that a name will go from 100 basis points to 500 basis points than shorting a bond at 60 and it going to 30. Now, you can run a portfolio of those that go from 60 to 30. The challenge is, if you did that for the last year or two, you would have been taken out on a stretcher. So it really comes down to the timing of that investment. The analysis is all the same. We have been in the process of starting a number of individual short positions, but you need to do it slowly, and you need to really have a view on timing of the catalyst. So the event-driven aspect of our portfolio really comes into play in timing a 3 to 6 month trade. It needs to be much shorter than that 6 to 18 month catalyst, because in 6 to 18 months, you short something at 70 with a 10% coupon, you're losing a fair amount of the trade right off the bat.
Thanks. Phil?
Thanks. My name is Phil Winewood. I'm the founder and CEO of Sear Capital.
Yes, please. Thank you.
Sear is a specialized hedge fund focusing exclusively on securitized products. And my background has been in that space. I spent 14 years at Credit Suisse First Boston, 8 years at Deutsche. Most of that time was probably 20 of the 22 years was in the securitized products business. I was Deutsche's global head of securitized products. Trading, structuring, and origination, and my last couple years at DB, I was running all fixed income sales and trading. We set up Sear 4 years ago. We spent probably the first half a year building out our analytics and risk management systems and all of our technology. We launched our flagship fund in May 2009. The firm is currently managing $1.5 billion in capital. And I guess I would define the firm as a broad focus attacking the securitized product space, in that we focus on distressed residential mortgages, commercial real estate, ABS, CLOs, CDOs, bank regulatory capital, and a whole host of other esoteric securitized products. The firm is 28 people right now, of which more than half, about 16 of them, are former colleagues from Deutsche. The style of the firm is just a very opportunistic approach to the market. We're not only investing in the U.S., but probably about 25 to 30% of our book is in Europe. We're a fundamental credit-oriented shop where we do a very deep dive granular approach to analyzing all of the underlying loans that are backing the deals. What I thought would be helpful is there are a couple of questions that are quite frequently asked of me, and some of them more common recently, which I thought would be helpful just to kind of address these. The first one is, why are so many securitized product shops springing up now? Why were they not around pre-crisis? And the obvious answer is the crisis created an ample set of investment opportunities, but why were there so few pre-crisis? And the fact of the matter is, when you look at the securitized product market, the market as I defined it as the one that we would invest in, at its peak there was about 2 to 2.5 trillion of issuance in a single year. And I define the credit securitized product space as everything excluding agency mortgages. Probably 90 to 95% of that were AAA bonds. Those that were mezzanine and subordinated bonds were being gobbled up for several years by the famous CDOs. CDOs bid those bonds up so high that they were probably quite rich from a relative value perspective, and it wasn't quite the purview of many other hedge funds to try and compete with the CDO. So bonds were being put away by money managers, mostly unlevered managers at the senior level. For any hedge fund or alternative asset manager to get an interesting return, the amount of leverage that you would have had to put on would have been quite tremendous. So clearly the crisis hits, and we're now looking at a universe of bonds that is the single largest distressed opportunity ever seen in the capital markets. There's still probably about $2 trillion outstanding of what we would define distressed bonds. But aside from that, so the other questions that I'm also asked, which is important to address to kind of understand our sector, is what inning are we in? Very famous question, everybody keeps asking it, which to me sort of implies that at a point in time, the game is over. So I would say that if you are just investing in this space just to pick out cheap legacy bonds, then there will come a point in time where the trade is over. But that's not what we do. The opportunity is going to persist for, I think, as long as we can see, because the dynamic within the banking universe has changed quite a bit. And therein lies what I believe to be the fantastic opportunity going forward. What I mean by that is what was, I think, a very critical part of my former firm's P&L for the fixed income division. And I think most of the investment banks would probably concur that this is where they made a fair amount of money. The investment banks were fabulous at originating deals, highly complex deals, for both large companies and small and medium-sized companies. They would repackage some sort of financial assets, hard assets, or some sort of receivables, provide the institution or the client that approached them with some sort of financing, and then the bank would then distribute much of the risk. That is the model of sales and trading. That is the model of investment banking. Repackage some risk and sell it off to other investors in a more palatable format or more liquid format. But what that always entailed is, and I'll just give you a perfect example, which is probably a little more up our alley. An operator of cell towers approaches a big investment bank and says, I have 3,500 cell towers. I'm looking to grow the business to 10,000 cell towers. I need to get some sort of financing. Can I pledge the cash flows that I have from Verizon, Sprint, T-Mobile, and whomever else is renting space in my cell towers? Can I pledge that to you to get financing? So a big investment bank would say, sure, value the cash flows, advance the company $200 million. Then once it's on the investment bank's balance sheet, package it up, sell off a whole bunch of bonds, maybe raise $180 million, so the basis is now $20 million, but they value that residual interest at $40 million, and they've made $20 million on the trade. Very simple to understand, very, very common in the investment banking world. What's changing going forward? The investment bank's appetite for retaining those residual risks has gone from voracious to very, very small. What they are looking to move this whole global banking model to one of, we're great at originating trades, we're great at structuring trades, we're great at distributing risk, we've got our clocks cleaned for retaining too much risk, let's distribute the more complex risk to investors as well, and that is how we will just keep the machine going. And also, once you layer in the higher regulatory capital requirements, that becomes even more essential. And then these more risky tranches are drawing even more capital based on the new regime. And when people talk about the shadow banking system, that is what they're talking about. So in this simple example I just laid out, in 50 different ways, that is going to play out through all of the global banks. What they're going to be doing is now saying, okay, the more senior and mezzanine risks, I will distribute them now as I have in the past using the same methodology. But going forward, I need to find some smart partners to share some of the more risky tranches, some of the more complex tranches, some of the possibly less liquid tranches with me, so that we could move all of the risk off our balance sheet and we act more in the capacity of an agent as opposed to a principal. That is the opportunity going forward. And then let's add in a couple of other things. The rating agency's approach to securitization was quite lax. And we all know that it was driven to a very large degree, though they would all disagree with this, but it was driven to a very large degree by competitiveness. If Moody's said you need 10% support to get a AAA and S&P was 8%, then, by all means, I'm just getting an S&P rating, and then let me see where Fitch was or some of the other guys. So playing the rating agencies off of each other, driving the level of credit support to lower and lower levels was what we were paid to do on the sell side. No longer is that going to be happening, and the agencies are taking a much more conservative approach and making securitization much more expensive by creating larger mezzanine tranches and larger subordinated tranches. So therein lies another opportunity for a fund like ours that specializes in investing in more complex securitized products. Let the AAA, LIBOR plus 10 or 15 tranches, let that continue to go to the money managers, but for mezzanine and more complex risk, that is where specialized hedge funds will come into play. So my answer to what inning are we in, it's not a baseball game. It's not going to be over in the ninth inning. Why so few hedge funds existed in this space prior to the crisis? Well, as I said before, people were misunderstanding the risk, misrating the risk. 95% of the market was AAA, not going to be the case anymore. And the more interesting classes of mezzanine and subordinated risk were retained by the principal finance groups or the flow trading desks of the various investment banks. So the model has changed so dramatically that the need for a fund like ours and the opportunity for a fund like ours is going to be tremendous going forward. So with that, what are the risks in our market? There's a host of risks, like investing in any other fixed income instruments. Interest rate risk, but you know what? For the most part, I would say 70% of the bonds that we invest in are floating rate. Those that aren't floating rate, we tend to swap. People do ask about inflation. How does inflation affect a fixed income portfolio? Well, because we're backed by hard assets, inflation is good. If the underlying assets inflate, that would give us a way greater level of protection. In amortizing assets, you also have prepayment risk. Not so much of an issue with the product that we're buying because, when you're buying stuff at a discount right now, prepayments would be good. It just, of course, increases your yield to maturity if you have a high degree of prepayments. When you're looking at new issue deals, prepayments are something that is part of the analysis, factored into the price. Greater prepayment risk, the greater yield you'll ultimately demand on the securities. Another interesting thing that nobody really talked about in the past is regulatory risk. So we're investing in these mortgage bonds. We have our models and we're forecasting what the cash flows are. What can the regulators do that could change the risk profile of the bonds that you're investing in? it has become, as home prices have bottomed out probably about 8 months or so ago, and they're starting to improve, the likelihood of the regulators to get more involved in creating more refinancing programs becomes less and less. So we view this as it clearly was a real risk 1 and 2 years ago, and it is slowly becoming less of a risk. The other obvious risk is asset prices. With the commercial real estate bonds and with the residential real estate bonds. Resi real estate fell from a peak, which was probably the beginning of 2006, to the bottom, which was probably just about 10, 12 months ago, fell about 34%. It's up about 4.5% over the past 12 months. And our view is you have to build in, everything is probability weighted. What is the likelihood residential real estate drops another 10 or 20%? Not very high, but we would put kind of a stress scenario that we build into our analysis is probably about a 15% drop from here in residential real estate, though the probability is quite low. So the magnitude of a drop in asset prices will be way less now, given that we haven't recovered from where we had initially fallen. Commercial real estate's a bit different. Interestingly, commercial real estate fell about the same peak to trough as resi, kind of mid-30s. It has actually rebounded a bit more. It's now probably down maybe 23 or 24% from the peak. But interestingly, when you look at the all of the various fundamentals of commercial real estate versus residential real estate, it would appear that over the past 12 months, residential real estate is repairing itself at a much quicker pace than commercial real estate. So, vacancies, for example, in commercial real estate has dropped from 12.5 to 11. Not a remarkable drop, but kind of steady state in the market is about 7.5 or 8. So it's moving in the right direction. Delinquencies has dropped. For example, in resi, delinquencies were running at a rate of about 19.5%. It's now down to about 8%. Very dramatic drop, and this is loans that are current rolling into default. So there has been, even though commercial real estate prices have improved more quickly than residential real estate prices, the underlying loans are repairing themselves at a much slower pace. And by the way, this is one of the things that led us to change our allocation. Our fund was 3 months ago 15% commercial real estate. We increased that to 25%. And for the past 6 weeks, commercial real estate bonds have been on fire. They've been increasing in value at a pace probably about 3 times the pace of residential real estate bonds. We think commercial real estate has got, that will be probably one of the outperforming asset classes of 2013. So just to finalize one last point on the risks in our sector, and a very big one that certainly affected our market quite a bit in 2011 is technicals. What do the technicals look like? The Fed announced as part of QE3 that they're going to be buying $40 billion a month in agency mortgage-backed securities. So, and there's a little debate as to when does this stop, but most economists and Fed watchers are predicting sometime in 2014. Very few are predicting that it stops in 2013. So you've got the Fed taking about $500 billion of agency mortgage-backed securities out of the market during this year. Where do those money managers put the money? Sure, some will go into equities, some will go into high yield, some will go into credit, but the closest cousin to agencies is non-agency product, other securitized product. A fair amount will come into the securitized product market. Couple that with the fact that distressed mortgage bonds, for example, has about $900 billion outstanding. That is paying off at a rather rapid rate, probably at about 13% a year. So we'll see about $120 billion of that disappear this year. So sort of do the math on that. You've got more investors coming into the sector. The sector is contracting. And then you've got the Fed chasing another $500 billion into other asset classes, which clearly securitized products will be the beneficiary of that. The technicals look very good. You can't discuss technicals without bringing up one other point. What really hurt our market and other credit markets during 2011 was the fear that the European banks are going to be dumping the product. So what happened in 2011? You had the sovereign debt crisis, which caused another mini crisis, or I should say a major crisis with many of the European banks. Barely recovered from the securitized products crisis. Now all of a sudden, banks don't trust each other as to what other banks have on the balance sheet, what their exposure is to various sovereign debt. Banks stop lending to each other. The liquidity crisis that existed in 2011 was far worse than the liquidity crisis that affected the banks in 2009 and 2008. Now we have the fears that all of these banks are going to be dumping assets. Did they? No. They barely sold any of them. The fact of the matter is, if you're a big global bank based in Europe, your cost of funds are normally LIBOR minus 15 to LIBOR minus 25. You have tens or hundreds of billions of high-grade assets on your balance sheet earning you LIBOR plus 20, 30, or 40. Then you've got these distressed assets that at the time were yielding you 10. So if you're the CFO or treasurer, you're kind of scratching your head saying, okay, I'm funding myself at LIBOR plus 150 now. I have 100 billion of assets that are earning me LIBOR plus 25, so I'm losing all that carry on those. I'm in the middle of a liquidity crisis. Should I be selling the high-grade assets, or should I sell this other stuff that is yielding me 10%, probably a little more difficult to sell, and it's running off rather quickly as defaults kind of run through the system? None of them sold the distressed stuff. If they needed to raise liquidity, they sold the higher quality stuff. So the big fear of the European banks dumping assets never really materialized. So I think when people look at the market now, are we out of the woods in Europe? Slowly repairing itself, not out of the woods. Could there be another mini crisis in Europe? Sure there could be. Will they sell distressed assets? Probably not. So I think from a technical perspective, the technicals look remarkably strong for the market, at least for the foreseeable future. So how are we playing this? We continue to invest in distressed RMBS. Yes, the yield is much lower than it was in the past. We're sort of looking at it as on a unlevered basis, probably about a 6.5% yield. Not as remarkable when compared to 12 or 24 months ago, but still, when you compare it to other fixed income sectors, it is still a pretty cheap bond price. And the other thing is, when we look at our sector as compared to high yield or investment grade, we're quoting yields with losses fully baked in. Others, when people say, well, high yield is trading at, the index is, let's say, 450 over, that's a zero loss assumption. So we are generally putting in quite conservative assumptions with respect to how many loans default, what the loss is on the default, and other parameters that ultimately affect the cash flows on the bonds. So RMBS yielding 6%. What are the opportunities for that this year? Well, clearly, if the underlying cash flows continue to repair themselves as they have been, if loans continue to get liquidated, and just for example, we were modeling about 80% of every loan will ultimately default. We've now revised those to 60%, which is still a pretty hefty number. We've also decreased the amount of money that we lose on a defaulted loan from probably 70 to the mid-60s. So we're still using fairly conservative assumptions and assuming a lot of loans default, but as those numbers continue to improve, the cash flows on these bonds will increase, and therefore the value of the bonds will continue to increase. Furthermore, if you have spread compression on these bonds, right now, let's say the yield is 6, maybe they're trading at a spread of 500 over, 100 basis points tightening, which is not at all unrealistic for this year. Times still has an average life of 4.5 years, is 4.5 points of price appreciation just by having 100 basis points of spread compression. So we see very good opportunities continue to exist in the RMBS space. In CMBS, we are more bullish on that. As I said, we increased our allocation. We almost doubled our allocation over the past 3 months. I think that trade will play out throughout the year. CLOs continues to offer a very good opportunity. Here we're being a bit more opportunistic. More recently, what we've done is we've approached the more difficult tranche to sell in many of the CLOs is the equity tranche. And many times when a big CLO manager wants to take a deal to the market, they have to sort of wait in line behind other guys who are looking to take a deal to the market, and pick their underwriter. The underwriter has to spend some time marketing the equity. What we've done is we've approached certain large CLO managers, said we'll take down 100% of your equity, we'll take down a portion of your double Bs, but the condition of doing that is our price is not going to be where you would otherwise distribute it if you waited 3 or 4 or 5 months to kind of get a deal done. We've done that several times. We've taken down equity that's probably yielding us 20%. And the only reason we're getting those returns is that we've taken down the entire tranche. We did it on a reverse inquiry basis. And we enabled a manager to access the market in a matter of weeks where it otherwise would have taken them months. So there are ways to originate transactions on a bespoke basis and create incremental returns. One other example, and then I possibly am almost running out of time. We've been an active investor in corporate loan securitizations coming out of Germany, for example. We bought many legacy bonds. The trade has worked out remarkably well for us. A large German bank, not my former employer, had approached us and saying, "Look, we're fairly capital constrained. We'd like to originate more middle market loans to many of these corporates." So what we did is we set up a bespoke securitization with them, where they're transferring a certain amount of loans into a trust as they originate them. They will own the senior tranche, the top 60%. We will own the bottom 40%. And that's going to give us probably about a 14 to 15% return on that investment. So there are lots of opportunities for us to kind of originate within the markets, not just waiting for legacy bonds to be shown to us by a dealer, but going out and sort of creating the situations ourselves. So I would say the combination of ability to structure deals, ability to originate and source transactions, and really the ability to just trade what's available in the secondary market will create excellent opportunities for the space. So with that,
thanks, Phil. I want to ask you a question. It sort of touches, if you go back to your cell tower example, of this future opportunities to originate. Wall Street, even when you were in that seat, burned a lot of investors, particularly in the resi market through the structured credit. And to what extent, if you are looking to replace what was the equity that the street took, when you were sitting on that side of the street, you had a vested interest to maximize the potential for the equity. Whereas today, if Wall Street is an agent across that capital structure, they might take that $20 million that was worth $40 million, they might only want to leave 4 or 5 for the equity and sort of distribute that across the other tranches so nobody comes after them if it goes badly. So how does that affect over time the opportunities that you have seen and that you think you will see as the sort of principal agent issue sort of shifts towards an agent model?
That's a good question. And you know what? What it comes to is, are you a price taker or are you a price giver? And if Wall Street were to, let's say, using your example, Ted, 5 years ago come to me and say, do you want to share the equity in the cell tower deal and, enormous gains? But now, let's say they build in a greater level of conservatism and they price the senior tranches at a higher level, and then they show me the equity. My attitude is, any way you want to structure it, I'm fine, so long as when I look at a deal, my guys dissect the legal documents, we reverse engineer the cash flows, and I price it accordingly. So if they want to sell me something at a given price, I'll say, you know what? And by the way, we've seen lots of stuff that we simply passed on. So would they have to price the senior notes at a wider level? Yes. But what will probably happen is, in my example, the $200 million they offered the cell tower company may only be $190 million, because otherwise the equity is not going to get involved. So one way or another, I understand what the liquidity would be in that retained piece. I understand what the risks are in the retained piece, and I'm going to have a return hurdle. And if they show something that doesn't meet the hurdle, by all means, go show it to somebody else, or just go back to the drawing board and restructure the deal. Don't pay the guy $200, pay him $190, because I'm not working for those economics. So it gets to, I think a lot of the guys that I have understand structured finance better than some of the young kids who are on Wall Street right now. So it's, show me a deal, and I'll either say yay or nay, or I'll tell you if the answer is no, go back and restructure it, and here are the circumstances by which I would do the deal.
Thanks. Well?
Thanks. Well, thanks for having me here today. Just to give a brief background on Centerbridge, for those that aren't familiar, Centerbridge was founded in 2005 by Mark Glugly and Jeff Aronson. Mark ran private equity at Blackstone. Jeff ran distressed credit and leveraged loans at Angelo Gordon. And the concept was to merge or bring these two investment philosophies into a single firm. Today, the firm manages about $20 billion in equity capital, focused on those two strategies, distressed and private equity. My background is in the distressed business. I've been in the distressed business for over 10 years, and that forms my perspective on the credit markets. So I'll try to follow there's a suggested framework of risk, opportunities, and outlooks, and I'll try to follow that in my comments today. So just to focus initially on risk, as Ted mentioned earlier today, risk today is somewhat easy. Given where yields are today in the high yield market and given where prices are in the distressed business, there is an abundance of risk. The FT, the Financial Times, ran an article over the weekend calling it a dash for trash. The first sentence of the article read, "Did the dash for trash just become a full-on charge into the rubbish heap?" My favorite quote from the article reads, "It's easier to find a dinosaur roaming around Central Park than a decent yield right now." I think I like that quote because my kids and I spent a lot of time at the Museum of Natural History, which is right next to Central Park, looking at dead dinosaurs. So when we think about risk, there's this concept of perceived risk and actual risk, and I'm sure you've heard this before. But when securities are priced to perfection and yields are low, the perception of risk is often low, but the actual risk to invest in capital is high because the risk of capital loss is very high. Conversely, when the perception of risk is high, when everyone else is afraid, that's usually when you want to invest capital because the actual risk of capital loss is low. It's a nice framework, but the problem is the framework doesn't really apply to today's market. The perception of risk isn't exactly low. There are a lot of things that worry investors, the fiscal cliff, Europe, you name it. But yields are very low. So I think it's our perception my perception, that risk is certainly mispriced today. So where are we investing capital, and how are we thinking about investing capital in the marketplace today? Well, over the past year, we've been better sellers of securities and raising cash. We have been, and we are patient. We are big believers in cycles, and we think the opportunities will come. But in the meantime, we continue to dig deeply into securities and to try to find the right opportunities and situations. So how do we think about how do we define the right opportunities and the right situations today? Well, the best investments that I find are investments that have what I like to characterize as layers. Layers, to me, represent multiple ways to win or multiple ways to make money. One concept of layers is securities with double dips. And so securities with double dips are securities that may have guarantees from different entities. And so as a consequence of those different guarantees from different entities, the security has a claim for par against each of those entities, or claim for full recovery. So there's more than one way to recover par on a fixed income claim, a bond claim. So the market calls these double dips. Another way to think about layers, another way that we think about layers is events and catalysts. And securities can have more than one event or catalyst. And the nice thing about event or catalyst is that we can help create them. They can be created. Layers as dips or layers as events or catalysts. We think when we take a look at investment, layers to us enhances our downside protection and reduces risk and improves the overall investment. I wanted to walk through a specific investment, a current investment, and one that we've had for a little while, just to demonstrate what I'm talking about and some of the concepts that I'm talking about with respect to layers. So TXU, Energy Future Holdings and all of its subsidiaries. I suspect that everyone in this room has heard of it. It's the largest LBO ever. Its bank facility is one of the largest syndicated, if not the largest syndicated bank facility in the leveraged loan market. Its TXU and its subsidiaries are one of the largest issuers of high-yield bonds. So to some degree, because of its size, Nearly every distressed and high-yield fund manager has likely taken a look and examined its capital structure and either has chosen to invest or not. So how do we approach TXU? Well, when we think about investing, one of the first things that we do is lay out the capital and legal structure and think about all the legal issues that could matter. When we looked at TXU, one of the things that we noticed almost immediately was an intercompany note from an operating entity to a holding company, to its holding company. And we dug a little deeper, and what we found was that the terms of this intercompany note were at arm's length, at least in our opinion. So there are a lot of issues that stem from this, including the fact that we believe that the company was in breach of its credit agreement. So in addition to our view on value, what we thought about value for TXU, we took the view that there was an event of default under its credit agreement, and that an event or catalyst would happen sooner than the market was anticipating. So it didn't take too long. Within 3 months of purchasing our securities, a notice of default was sent to the company, as you may remember, in the beginning of 2011. A few months later, the company announced a very large amend and extend of its $24 billion bank facility. Over 80% of the lenders chose to extend. We didn't think the economics were worth it, so we chose not to participate. So where did that leave us with respect to our investment? Prior to the amend and extend, as I said, there were $24 billion of bank facility, of which $2.7 billion of revolver matured in 2013. Post this amend and extend, only $650 million was left of the bank facility, all revolver, that matured in 2013. Everything else matured afterwards. Our investment was, because we chose not to participate, our investment was and remains in that 2013 revolver. So in effect, post the exchange, we became the company's earliest maturity, while also being at the top of the capital structure because we were first lien. And so when investors take a look at a capital structure, a corporate structure, oftentimes you have to make a trade-off between being the earliest to mature, but that usually entails being the most subordinated part of the capital structure, the riskiest part of the capital structure, or being the top of the capital structure, but the latest to mature. Through this process, we were able to create a tranche of securities that was both at the top of the capital structure, first lien, but also the earliest maturity of the company. So wind forward to a month ago, December 2012. The company is still in bad shape. It's arguably worse than it was a year ago. In the last week of November, TXU draws on its revolver. Not crazy, but a bit more than I would have expected at this time of year. So I think about TXU every day. TXU is one of our largest positions in the fund. And I thought about this revolver draw, and it stuck in my head for about a week and a half. And I kept asking myself, why would a company draw a little bit more than what I thought it would need to on its revolver? And then a hypothesis came to me. The hypothesis was, what I thought, or what I believed, was that the company was concerned about its audit. The company was concerned about receiving a going concern qualification in its audit that's in 10K. And it's interesting because the company had reached out to investors and spoken to a lot of the investment community over the past 3 to 4 months, and it said, we're not worried about this year's audit. If there is an audit, and if we are concerned about a going concern qualification, it's next year's audit, it's not this year's. Receiving a going concern qualification for a company like TXU in the state that TXU is in is painful, and it could result in an immediate bankruptcy filing. So it's one rationale for the company and what it said. Company speaking when it speaks with investors to make those type of comments. But why would a company as we think about that, why does that make sense? Why could the company be concerned about its audit? Well, if you think about the way TXU has managed its balance sheet, it has generally had low cash, but it's kept its access to its revolver. When auditors go through the year-end review process, when they go through the audit process, particularly for a company like TXU that's in deep distress, they don't often give the company credit for its full revolver. because there are things that could happen throughout the year that may cause that revolver to be unavailable to them. So what do companies do in this situation? Well, one of the things that companies can do is they draw on the revolver. So they go to the auditors and say, I have access to this revolver because I've drawn it, and the cash is on my balance sheet. So, and that's what I thought TXU was doing here. No clear evidence, but that was just my hypothesis. So what do we do with this, and how do we capitalize on this? Like I said, I think about TXU quite a lot. And one of the things that, so I was sitting around one weekend, it kind of, an opportunity or solution kind of came to me. What if we went to the company and extended our revolver? So there were $650 million of 2013 revolver. It was really the only maturity of the company in 2013. We own 2/3 of that revolver. So what if I went to the company and said, we'll extend our 2013 revolver to beyond 2013 for a consent fee? And what if I asked, what if I structured that consent fee as paid in kind versus paid in cash? Right, so oftentimes consent fees are paid in cash. What if I said, don't pay me in cash, but pay me in kind in first lien securities? The structure hasn't really been done before. I haven't seen it, but why not? And the advantages to the company are obvious. The company removes its only 2013 maturity. It removes it in a way that preserves liquidity. And it helps it with its audit process, and the risk of a going concern qualification is lower, is reduced. It obviously benefits us because given where we would negotiate this, we could receive par or near par for our securities. So with that, I contacted the company on December 10th. On December 21st, we had assigned executed agreement, and the company released the details of that in an 8K. And the company got its extension, and the economics of the agreement allowed us to essentially recover near par in our securities. By the way, the hypothesis that I had earlier that the company was concerned about its audit, during our negotiations, the company drew fully on its revolver, and I asked the company because we had signed a confidentiality agreement. The company asked the company why they did that. And they conceded and confided that it was because they were concerned about their audit, forthcoming audit, and their going concern qualifications. So I just wanted to walk you through that investment in a little bit more detail, just because I wanted to give you an example of how we look for and create layers and create opportunities and events and catalysts. Here we laid into our thesis-specific catalysts, and we helped create them. You'll notice in my conversation about TXU that I didn't just bring up I didn't discuss the price of natural gas, even though that's an important component of value for the business. I also didn't discuss other aspects of the business, including the design of the energy markets in Texas, which are, again, also an important component of value. Because when we looked at this investment and we tried to create multiple layers, we were able to make money at the end of the day, despite the continued fall in natural gas prices. So here in this situation, we also made money because we were able to find a solution that worked for the company. We think about that, and we focus on that a lot at Centerbridge. How do we use our capital to help solve a company's problems? And we think about that a lot. So what's the outlook, and where else are we looking for layers and being creative with our capital today? There are certain specific sectors. Jeff mentioned energy. We also think shipping globally is an interesting sector. And we are actually seeing a fair amount of deal flow in Europe. Now, I've been spending a lot of time in the shipping space in particular. And just to describe the opportunities there, the way that I think about that space, there's $400 billion of global loans tied to the shipping space. To put that into perspective, the North American high yield market is about $1 trillion. The North American leveraged loan market is about $600 billion. So one sector globally in loans is $400 billion. And much of it is in distress, away from pockets like LNG, liquefied natural gas, and offshore. So sectors like crude, product tankers, dry bulk, containers, all of that is in distress. And when you think about the $400 billion of global loans, the top 10 institutions that are exposed in that $400 billion represents 60%. So the top institutions hold 60% of that $400 billion. Of those top 10 institutions, 9 of those 10 institutions are European banks. So what you have is a sector, $400 billion, away from some pockets, a sector globally that is in distress, where the traditional sources of financing for that sector is no longer available because those banks are looking to shrink their balance sheets, and they're not really looking to make new loans. So when we think about this space, and again, we think deeply about using our capital to help solve problems. We think this is a real opportunity for us because it's an opportunity for us not only to solve these companies' liquidity problems, day rates for shipping companies and shipping entities have come down tremendously since its peak, but we can also help companies seize the opportunities in the distress. So if we overcapitalize some of these entities, they can use that cash, and we can provide that cash to them to take advantage of the distress market and to grow when no one else can. So we've been spending a lot of time in the shipping sector. We've been focused on it for a couple of years, most intensely in the past year, because where rates are and where value is today. And we've gotten close a couple of times. And we've recently made our first investment in the shipping space. But we think there'll be a lot more opportunity over the course of 2013 and into 2014 because of the size of the opportunity, but also of the dearth and lack of capital into the space. The other area of focus for us is Europe. We've sent a lot of folks over there, and a lot of other funds are focused on Europe, and people are looking at Europe. But we think we have an edge in the way we think about investments. In particular, because of our size and the amount of capital that we manage, we think we can be a real solution provider to a lot of companies and a lot of banks. As an example, over the past 12 months, we, along with two partners, purchased a 25% stake in the subprime auto finance business of Banco Santander. We purchased this in a structured transaction that limited our downside risk, where we retained the economics of that 25% stake. Banco Santander kind of accepted our terms because by selling that 25% stake, it allowed them to book a gain and help with our capital ratios. So there are a lot of these different type of opportunities that we're seeing in Europe. We're in active dialogue with a lot of banks and institutions about those opportunities, and we think there's a lot of places for us to deploy capital. And we've sent a number of senior folks to Europe to seize those opportunities. So in summary, we see a lot of risk today, given where yields are today. We plan to be patient, but we will continue digging for the right opportunities. We think they're out there, but we think we have to be creative. We have to be creative in how we structure them and structure solutions that work both for us and for the companies that we invest in.
Thanks, Bao. Before we open it up to questions and before the lightning round, I want to ask a game theory question, which is when you talked about that amend and extend in TXU,
yeah.
Could you touch on why would someone participate in that amend and extend if the people who are holding out have a much superior place in the capital structure after? And then secondly, oftentimes you're in credits with the same other group of distressed investors.
Yeah.
And so what's the second order game theory the next time you're in a situation where you were the guys who held out this time, but how does that play out over time?
It's a good question, and it's not an easy one to answer. It varies for every situation, and also folks that hold securities can be incentivized in many different ways. Whether they own CDS, for example, and they may have different incentives for the company, and ultimately it comes down to the economics of what is being provided. The business of the company was different at that time. It was middle 2011. Understand that the sponsor, there were relationships involved as well as it often are, and that helped kind of pull some of these amend and extends and get them to succeed. But it's not an easy question to answer. You really have to think through it. There is a very big game theory component to it, and you never know the answer. You never know the answer until you get through it, and you have to essentially decide for yourself as an institution. In this situation, a lot of folks did extend, but would it have surprised me had fewer institutions extended? No, not really. And that would have, again, the second order game theory aspects would have been very different. If the 2013 revolver were larger, that would have been a different story too. So it's hard to forecast and predict a lot of this stuff. I think you just need to think about, each institution needs to think about what's right for themselves and sort of in their own economic interest.
Great, thanks. Okay, quick lightning round. We're going to be talking about rates, so higher or lower. U.S. default rate over the next 12 months. Jeff?
U.S. default rate. U.S. lower.
Phil?
Credit defaults?
Yeah.
Or, next 12 months lower.
Val?
I'd probably agree, though, over the next kind of 2 years, higher, I would say.
Yeah, you're all wrong. Okay. 10-year, U.S. 10-year, next 12 months, higher or lower?
For me?
Let's go. It's a lightning round.
Lower.
I think it'll be higher.
I'm sorry, the
U.S. 10-year.
probably higher.
High yield bond yield. Let's keep it simple. Higher or lower?
Lower.
I'll take the opposite on that.
Again, it's a timing. I think it's got to go higher, right? At some point. It
Last
can't stay
one,
there forever.
investment grade yield. Higher or lower?
Lower.
It goes the same way as high yield. I think it'll be higher.
Same as high yield.
Great. Questions?
What's that? What's your coffee?
I take it that none of you think there's any substantial risk in an interest rate spike based on debt deficits, bank reserves, the Fed balance sheet over the next 2 years. And so you're not concerned or you're not comparing with a tail risk.
I mean, I could attack that. I mean, for what we're investing in, higher interest rates isn't necessarily a tail risk for us. Higher interest rates would probably be a good thing. Higher interest rates should be accompanied by a greater level of economic growth, which would be good. Higher interest rates will probably be associated with a slightly higher rate of inflation, which ultimately would be good. The bonds that we invest in are primarily floating or swapped to floating, so we would get ultimately a higher return. So, you know, the one stress point with our bonds is that if you are a borrower having a loan and you have a floating rate loan and all of a sudden your interest rate is higher as a result of that, then could that force a borrower into bankruptcy, whereas otherwise they may not? That is the one point of tension. But when you weigh in all of the positives for our portfolio, I think we would have a better performing portfolio in a higher rate environment.
You know, the way that I would, you know, that topic didn't come up in kind of my conversation. And, you know, we manage our portfolio much like probably the way Jeff does. We focus on kind of events and catalysts, and we try to think about those situations. And that's really what we're focused on. As it pertains to interest rate risk, when we think about buying securities or bonds that are certainly long dated, that comes to mind definitely. When we think about the opportunity set and where we deploy capital, it's really on situations that are event driven, and so we don't consider ourselves experts on the yield curve. You know, the question on where the 10-year was is kind of my speculation. We don't try to be experts on that, and we try to focus on what we can control to some degree. But we are certainly mindful of it when we buy long-dated bonds, but we don't try to predict that.
So our investments really are comprised of two different strategies. Buying collateral at a discount, where most of those types of investments are, whether they're performing or not performing, they're floating rate. So there's kind of an offset from that perspective. And again, you know, backing off what Bao said, like there's a catalyst, there's a 6-month, 18-month catalyst, so we're somewhat insulated with the floating rate aspect. And then on the fixed incomes, on the bond side, you know, as I mentioned earlier, we kind of view ourselves more like a long-short equity fund than a true credit manager. So when we're looking at these investments, the carry component is so small, and the capital appreciation aspect is really the majority. You know, we're buying a bond at, on average, our portfolio has a 58-cent. The last 12 months, our average price point for our non-collateral type positions are 58 cents on the dollar. And so most of those types of bond investments are ultimately going to become the fulcrum security in a reorganized company in some way, shape, or form. And so what we're more cognizant of is equity market valuations in most of those positions than true high yield, with a high yield or high grade market stands. As an aside, just to, you know, I personally believe that we're going to stay at this level, and it's going to have to stay at this level from a rate perspective, because I don't think our government or many of the other governments in this world can deal with their debt loads right now and allow interest rates to really kind of come away from them, because if they do, we have a lot more challenge than we're talking about right now.
I had a quick question for Jeff. I'm intrigued by the liquidation market. It does seem like Lehman Brothers was such a monster of losses, and that kind of the gift that keeps on giving. Are there other liquidations? I mean, what does that landscape look like? Just give us a little bit more color on that.
Sure. So liquidations typically occur at the end of a bankruptcy cycle. So if you look back to the global crisis, 08, 09, we're now coming towards the end tail of a lot of those types of bankruptcies. And so a Lehman, Madoff, Glittner Bank, Kaupling Bank, some of the larger names that have been in the credit space, probably I would say average life on those positions is somewhere within the 2-year time period. Maybe Lehman, because it's so large, might last a little longer. But then again, you've had asset sales like on their largest asset, which they sold for a premium to where most of the market was viewing that sale to come. From our perspective, that is an area that probably we'll see some continued growth in terms of the offset of pay down. So Lehman Brothers paid down, you get a pay down every 6 months. Madoff just made a very large pay down in August of last year. But then again, you had Hostess. You've had ResCap now go down that path. You've had a number of new entrants into the market to offset. I mean, it's hard to offset Lehman Brothers, so let's say take Lehman Brothers out of the equation, but other types of liquidations. We think that it is going to be a gift that keeps on giving. We think that you do have another 2+ years of kind of value there. I think there's clearly very high barriers to entry in most of these types of investments. So you have this limited group of people. While you think this hedge fund community is very large, you take a Lehman Brothers, every week, every day, you're seeing another bank or another institution selling off their claim against Lehman Brothers. And it's just this continued kind of cycle of new opportunities. And that's why you still can, from our perspective, our base case methodology gets you to a 15% IRR on Lehman over the next couple of years, annualized. And we think upside, you could actually get into the low to mid 20s if everything goes right. There are others who, would say you could get into the 30% range. We think that's somewhat aggressive. But Madoff right now is not that interesting from a claims perspective. We still have positions, and it's still probably a 12% base case IRR on straight Madoff claims. But then you have, 50 feeder funds that some of the banks, like what we're seeing out of some of the European banks and other banks, has been these claims that have come out. So there was a $250 million claim out of one of the feeders, a Defender claim that came out, a month ago, and we think that investment could probably generate a 30 to 40% type of IRR. So you just have to keep playing, keep watching these names, and not that I like using this terminology, but it's like this carcass is large and you need to just keep carving up, and there's a lot more on it. So, thank you.
Yeah, Brian?
Jeffrey, maybe could you comment on the IRRs that you're seeing in middle market type transactions that you're doing, both here in the U.S. and then also in Europe?
Sure. It's unlike the liquidation space, where it's kind of a very defined comparison. On middle markets, there are investments where you could buy a first lien security, buy a second lien security, you could buy an equity component. So it's hard to say straight out what that type of return is going to be. What I can say is there's no question, there's that illiquidity and premium that's involved in a lot of these situations. So not only is there a challenge for a lot of people to get for a very large fund, some of these names just don't make sense because it doesn't move the needle for them. So it becomes just less competitive. And then on the flip side, for banking institutions right now, there were a number of articles over the past 3 or 4 months in the Wall Street Journal that speak to the fact that regulations have really made it challenging for banks to make loans to some of these companies because of the capital ratios that get put forward are higher. That there's almost like a penalty for making a loan to a smaller company than a larger. You add all that up, and from our perspective, what it just becomes is just greater, lower risk to a higher reward type variable. And so, a name like Perstorp, which I mentioned earlier, which was the Swedish specialty chemical company, we bought a LIBOR plus 1250 mezzanine tranche 9 months ago. That was trading between 75 and 80 because you had 2 European banks that wanted to sell this position. You had a financial sponsor, PAI, out of France, who had $500 million in their latest fund. It was their largest single investment in their latest fund at risk, and the company was creating free cash flow. It was doing quite well. Number one, number two market share for every single chemical that they manufacture. So really good business, and yet people were nervous at the end of last year because they had a first lien loan that maybe it was levered 3 times, whether or not they were going to be able to refinance it. And we were in a third lien loan. Ultimately, they refinanced the whole structure, and so our paper that we bought between 75 and 80, we got paid out of par. Now, that's a great, that makes us happy, but clearly there are losers as well. And so from the perspective of middle markets, what you really just need to know is you got to have that offset between what kind of return threshold you have versus the illiquidity that comes with it. From our perspective, we don't like illiquidity. We like that 6 to 18 month type trade and turning over our book one to 1.5 times a year. So, we find ourselves kind of in a middle ground where I would say on the collateral basis, most of our investments yield or expect a 15% type return. And then if you get down into the lower tranches, the equity tranches or mezz tranches, we look for something in excess of 25%.
One more question. Sue?
Yeah, you mentioned 6 to 18 months. Could the rest of you comment on liquidity on 2 levels? What's the average hold period on your investments? And then what kind of lockups do you have on the funds that you raise from investors?
Is that to me or to all?
Well, to all of you, actually.
I've been speaking a lot. Do you want to start?
So the first part of the question was in terms of liquidity of our securities?
On investments, and then,
Yeah.
how long does an investor lock up their capital in investment?
I think to answer the first question, most of our investments tend to be kind of multi-year investments, multi-year holding periods, just because it does take a while, can take a while for investments to play out. We'd love to kind of buy a security and have kind of event take place in 4 months or whatever, a short period of time. But sometimes it takes work. Like the TXU example, that investment we've been in for 2 years. A lot of times it takes work. It's getting having a dialogue with the companies, having a dialogue with folks around it, and trying to create the kind of catalyst and creating events. So a lot of our investments are multi-year, 2 to 3 years, I would say. In terms of our capital and the way that we've managed it, we have a couple different vehicles, really just 3 vehicles on the credit side and then 2 vehicles on the private equity side. Most of those vehicles have they're the private equity vehicles, and 2 of our credit vehicles are private equity style vehicles. So, a couple of years of an investment period, and then a number of years of harvesting. And then our hedge fund vehicle has there is liquidity in the hedge fund vehicle, quarterly liquidity.
So with respect to SEER, when we compare ourselves to many of our competitors, you see securitized products funds at both ends of the spectrum. Some fancy themselves as active traders. Others, position themselves as buy and hold. We don't subscribe to either of those 2 extremes. I think the guys who are, very active traders or sort of playing on momentum and, buying a bond from one dealer at 60, trying to pawn it off at another dealer at 60.5 or 61. Don't believe they tend to do the deep dive credit work. The other end of the spectrum, funds that are just kind of buy and hold in our space, also I think are just not delivering enough alpha to their investors. There will become sectors, there will be sectors that will become rich at points in time, and there'll be other sectors that will become cheap. And I think it's incumbent upon you, if you're actively involved in the markets and you're trading the markets every day, to move your capital from one sector to another to take advantage of that. So we're probably right down the middle. And we turn over our book probably 2 to 3 times per year. With that, our fund has, after an initial 1-year lock, we offer quarterly liquidity. And that is in our flagship Partners Fund. We are just launching probably, this week we've just started marketing it. We're launching a private equity style fund, which will have a draw period and an investment period. And that is going to be targeting less liquid opportunities that we come across in the marketplace.
So we're fairly concentrated. We have about 20 to 25 positions in our book, and it's kind of a very competitive process to get something new into the portfolio. Yet, in times, surprisingly enough, over the last 2 weeks, we've probably added 3 new positions to our portfolio. We're finding quite a bit of interesting opportunities right now. And so when we look back since inception, we've turned our book over, call it 1 to 1.5 times a year. Again, it depends on whether or not the majority of our positions are at the top of the stack and that senior capital structure portion, or the more in the fulcrum securities in the middle, because the middle investments typically have some kind of process involved, and those processes can last 6 months to 18 months. So I would say, anywhere from 9 months to a year and a quarter on average, and so our portfolio, the way we've structured liquidity, is such that we look at each name when we put it into the portfolio, and we put it into one of 3 pools: liquid, semi-liquid, or illiquid. That illiquid component of our portfolio probably demands the highest threshold of expected return. So we will put nothing into that portion of our portfolio that does not have at least a 50% expected IRR. That 50. So it creates a scarcity concept. We only buy illiquids when we only buy things that are really less liquid. We couldn't just punch out pretty quickly if we really think there's a lot of return. We're not going to just buy a bank loan that's yielding 10, 11%. We like it, but it's completely illiquid to have it in our book. We want to have the ability to turn our positioning around, because one of the ways we manage risk, one of the main ways we manage risk, is by utilizing gross positioning, just up and down, something we learned running these proprietary desks on the sell side. So with that structure, what we've decided to do in terms of liquidity is we have a 1-year soft lock on our master fund, but we have an investor level gate, and that investor level gate gives us 4 quarters to sell down our positions if we do have liquidity needs for our investors. Similar to Phil, we are actually in the process of launching a more private equity style fund. That fund will focus particularly on merchant power. It will be a merchant power fund because we do believe the next 2 to 3 years will offer pretty interesting opportunity there. And so we will have, I think, some new special purpose vehicles that will have a longer, kind of more illiquid type of investment. Thank you.
Not a lot of housekeeping today. February 15th, we'll be here for Investment Recipes for Challenging Times, and I'm pleased to announce that Bob Aaron is back. Bob, welcome. Would you like to say anything?
I just want to thank everyone for holding my seat for me while I took an 18-month journey, and it is good to be back. And if I was here in between, I don't remember it, and I can't be held accountable for anything I said. Thank you.
You were here, Bob.
That's a shame.
No, welcome back. Good to have you. Bob's been with us for 11 years as an underwriter, so please thank Bob. He provides us with orange juice capital. Thank you. And Jeff, Phil Bell, very good job. Thank you very much.
Thank you. Thank you for having us.